What are the items of income derived from sources partly within and partly without the Philippines? Items of gross income not allocated to sources from within or without the Philippines shall unless unmistakably from a source within or source without the Philippines be treated as derived from sources partly within and partly without the Philippines. RR number 02-40, section 162. Gains, profits, and income from the sale of personal property is treated as partly from sources within and partly from sources without the Philippines, if the property was 1. Produced, in whole or in part, within and sold without the Philippines, or 2. Produced, in whole or in part, without and sold within the Philippines. Section 42. Gross income definition. Gross income means all income derived from whatever source, including but not limited to the following: 1. Compensation for services in whatever form paid, including but not limited to fees, salaries, wages, commissions, and similar items. 2. Gross income derived from the conduct of trade or business, or the exercise of a profession. 3. Gains derived from dealings in property. 4. Interest. 5. Rents. 6. Royalties. 7. Dividends. 8. Annuities. 9. Prizes and winnings. 10. Pension. And 11. Partners' distributive share from the net income of the general professional partnership. Section 32. Note: the definition of gross income is broad enough to include all passive income subject to specific rates or final taxes. However, since these passive incomes are already subject to different rates and tax finally at source, they are no longer included in the computation of gross income, which determines taxable income. Commissioner of Internal Revenue versus Philippine Airlines. Discuss the concept of income derived from whatever source. All income not expressly excluded or exempted from the class of taxable income, irrespective of the voluntary or involuntary action of the taxpayer in producing the income and regardless of the source of income, is taxable. Gutierrez versus Collector of Internal Revenue. Are the proceeds of a stolen or embezzled property included as part of gross income? Yes. Embezzled money constitutes gross income. It opines that unlawful as well as lawful gain is comprehended within the term gross income. James versus United States. Compare gross income vis-a-vis net income vis-a-vis taxable income. Gross income. All income, gain or profit subject to income tax under Section 32, letter A of the NRIC. Net income. Gross income less statutory deductions. RR number 02-04, Section 36. Taxable income. Pertinent items of gross income specified in this code, less deductions, if any, authorized for such types of income by this code or other special laws. NIRC as amended by Train Law, Section 31. Note: the phrase and or personal and additional exemptions is removed in the definition pursuant to Train Law. What are the sources of income subject to tax? 1. Compensation income. 2. Fringe benefits. 3. Professional income. 4. Income from business. 5. Passive investment income. 6. Income from dealings in property. 7. Annuities, proceeds from life insurance or other types of insurance. 8. Prizes and awards. 9. Pensions, retirement benefits, or separation pay. And 10. Income from whatever source derived. 11. Partners' distributive share from the net income of the general professional partnership. Section 32. Define compensation income. All remunerations for services performed by an employee for his employer under an employer-employee relationship, unless exempted under the provisions of the NIRC, are considered as compensation income. Note: the basis upon which the remuneration is paid is immaterial in determining whether the remuneration constitutes compensation. Thus, it may be paid on the basis of piecework or a percentage of profit, or may be paid hourly, daily, weekly, monthly, or annually. Compensation may be paid in money or in some medium other than money, as for example stock, bond, or other forms of property. What is the test to determine whether an income is compensation or not? The test is whether such income is received by virtue of an employer-employee relationship. Note: remuneration for services constitutes compensation income even if the relationship of employer and employee does not exist any longer at the time the payment is made between the person in whose employ the services had been performed and the individual who performed them, as long as the employer-employee relationship is existing at the time the services were performed. Are love gifts received by pastors from their pastoral ministry considered taxable compensation income? Yes. It is subject to income tax and withholding tax. Every form of compensation for personal services is taxable, regardless of how it is earned, by whom it is paid, the label by which it is designated, the basis upon which it is determined, or the form by which it is received. When are bonuses, 13-month pay, and other benefits part of compensation income? When the bonuses, 13-month pay, and other benefits exceeded the threshold amount of $90,000, the excess of which shall be subject to tax. Note: the amount of tax-exempt 13-month pay and other benefit is increased to 90, old 82,000 pursuant to train law. Fringe benefits. What is fringe benefit? It means any good, service, or other benefit furnished or granted in cash or in kind by an employer to an individual employee, except rank-and-file employees. What is fringe benefits tax? The fringe benefits tax, FBT, is treated as a final income tax on the employee that shall be withheld and paid by the employer on a calendar quarterly basis. Who pays the fringe benefits? The tax. The fringe benefits tax is actually due from the employee but paid by the employer for and in behalf of the employee. The tax is additional cost to the employer when the employee pays the FBT in behalf of the employee. The tax becomes an additional benefit of the employee subject thereto. Thus, the need to gross up the monetary value of the fringe benefit received in computing the FBT due thereon. Discuss the scope of fringe benefit tax. The fringe benefit tax covers only the taxable fringe benefits of managerial and supervisory employee. For purposes of fringe benefit tax, RR number 3-98 clarifies that taxable fringe benefits exclude those items considered as compensation income, Bangawan income taxation, who are considered as managers, supervisors, rank and file. Managerial employees refers to those who are given powers or prerogatives to lay down and execute management policies and or to hire, transfer, suspend, lay off, recall, discharge, assign, or discipline employees. Supervisory employees are those who effectively recommend such managerial actions if the exercise of such authority is not merely routinary or clerical in nature, but requires the use of independent judgment. Rank-and-file employees mean all employees who are holding neither managerial nor supervisory position. What is the tax treatment of fringe benefits? If the benefit given is not exempt from tax and the recipient is a 1. rank-and-file employee, the value of such fringe benefit shall be considered as part of the compensation income of such employee, subject to withholding from the employee's compensation and to the graduated tax rate under Section 24, letter A. Number 2. Managerial and supervisory employee. The value shall not be included in the compensation income of such employee, subject to tax. The fringe benefit tax is instead levied upon the employer who is required to pay. Section 33. Discuss the special treatment of FBT, or fringe benefit tax. FBT on fringe benefit is paid by the employer, but he is allowed by law to deduct the grossed up monetary value of the fringe benefit furnished or granted to the employee as a business expense in determining his taxable income, provided that the final tax imposed under Section 33 has been paid. The FBT is not an additional tax on the employer. He can claim the fringe benefit and the FBT as a deduction expense from his gross income. What is the basis of the fringe benefit? The fringe benefit tax is imposed on the grossed up monetary value of fringe benefit furnished, granted, or paid by the employer to the employee, except rank and file employees, whether such employer is an individual, professional partnership, or corporation, regardless of whether the corporation is taxable or not, or the government and its instrumentalities. What does the grossed up monetary value represent? The grossed up monetary value represents 1. The whole amount of income realized by the employee, which includes the net amount of money or net monetary value of property which has been received, and 2. The amount of FBT thereon otherwise due from the employee but paid by the employer for and in behalf of the employee. What are the taxable fringe benefits? Fringe benefits subject to FBT are the following: 1. Housing. 2. Expense account. 3. Vehicle of any kind. 4. Household personnel such as maid, driver, and others. 5. Interest on loan at less than market rate to the extent of the difference between the market rate and actual rate granted. 6. Membership fees, dues, and other expenses borne by the employer for the employee in social and athletic clubs or other similar organizations. 7. Expenses for foreign travel. 8. Holiday and vacation expenses. 9. Educational assistance to the employee or his dependents. And 10. Life or health insurance and other non-life insurance premiums or similar amounts in excess of what the law allows. Q. Discuss the FBT rates to come up with the grossed up monthly value. The rates of fringe benefit tax vary depending on how the employees are taxed. The reason is that the FBT tends to recover income tax of the employee, so the rate follows the income taxation of such employees as shown in the table below. I'm sorry, I cannot read the table. Note, prior to 2018, the FBT was 32%. 2. Upon effectivity of the train law, Special Alien Employees or SAE and Special Filipino Employees SFE are now subject to graduated tax rate on their compensation income. Consequently, the FBT rate applicable to them shall be 35% beginning January 1, 2018. Therefore, the 15% tax rate illustrated in the table shall only apply if the taxable fringe benefit was given prior to 2018 taxable year. Discuss the valuation of fringe benefits. If the fringe benefits is granted or furnished in 1. Money or is directly paid by the employer, the value is the amount granted or paid for. 2. Property other than money and ownership is transferred to the employee. The value of the fringe benefit shall be equal to the fair market value of the property. The fair market value of the property is the fair market value determined by the BIR Commissioner, or the FMV determined by the provincial or city assessor, whichever is higher. 3. Property other than money, but ownership is not transferred to the employee, only the usufruct. The value of fringe benefit is equal to the depreciation value of the property, RR number 03-98 section 233. Letter A. What are the instances when housing privilege is subject to FBT? It may arise under any of the following. 1. Employer leases residential property for use of the employee. 2. Employer owns a residential property and assigns the same for use by the employee. 3. Employer purchases a residential property on installment basis and allows use by the employee. 4. Employer purchases a residential property and transfers ownership to the employee. Or 5. Employer provides a monthly fixed amount for the employee to pay his landlord. RR 0398 section 233. What are the housing privileges not subject to fringe benefits tax? The following are not taxable fringe benefits. 1. Housing privileges of military officials of the EFP, consisting of officials of the Philippine Army, Philippine Navy, and Philippine Air Force. Rationale: the state shall provide its soldiers with necessary quarters, which are within or accessible from the military camp, so that they can readily be called to meet the exigencies of their military service. 2. Housing unit which is situated inside or adjacent. The unit is located within a maximum of 50 meters from the perimeter of the business premises to the premises of a business or factory. And 3. Temporary housing for an employee who stays in a housing unit for 3 months or less. What expenses incurred by the employee are subject to FBT? They are expenses incurred by the employee, but which are paid by his employer, except when the expenditures are duly receipted for and in the name of the employer, and expenditures do not partake the nature of a personal expense attributable to said employee. 2. Expenses paid for by the employee but reimbursed by his employer, except when the expenditure are duly receipted for and in the name of the employer, and the expenditures do not partake the nature of a personal expense attributable to said employee. And 3. Personal expenses of the employee paid for or reimbursed by the employer, whether or not the same are duly receipted for in the name of the employer. Now, representation and transportation allowance, which are fixed in amounts and are regularly received by the employees as part of their monthly compensation, are not treated as taxable fringe benefits but are considered taxable compensation income, subject to regular tax rates. What are the instances when motor vehicle privilege is subject to FBT? It may arise under any of the following. 1. Employer purchases vehicle in employee's name. Employer provides employee cash for vehicle purchase. Employer purchases car on installment and the ownership of which is placed in the name of the employee. Employer shoulders a portion of purchase price. 5. Employer owns and maintains the fleet of motor vehicles for use of business and employees. 6. Employer leases and maintains a fleet of motor vehicles for the use of the business and employees. 7. The use of aircraft owned and maintained by the employer. And 8. The use of yacht, whether owned and maintained or leased by the employer. Is the use of aircraft subject to FBT? No. The use of aircraft, including helicopters owned and maintained by the employer, shall be treated as business use and not subject to FBT. Is the use of yacht subject to FBT? Yes. The use of yacht, whether owned and maintained or leased by the employer, shall be treated as taxable fringe benefit. Note: the high cost of ownership of aircraft makes it inherently prohibitive or impractical to be for personal use. Thus, aircraft are deemed by regulations as solely for business use. Hence, they are exempt from fringe benefit tax. Yachts, though pricey on the other hand, generally lack any sensible business purpose aside from being for personal pleasure. Hence, its depreciation value is subject to FBT in full. Are household personal expenses of employees borne by employers subject to FBT? Yes. The following personal expenses of the employee which are borne by the employer shall be treated as taxable fringe benefits. 1. Salaries of household help, personal driver of the employee, or other similar personal expenses like payment for homeowners association dues, garbage dues, etc. When is interest and loans obtained by the employee from the employer subject to FBT? If the employer lends money to his employee free of interest or a rate lower than 12%, such interest foregone by the employer or the difference of the interest assumed by the employee and the rate of 12% shall be treated as taxable fringe benefit. Are membership fees, dues, and other expense borne by the employer for his employee in social and athletic clubs or other similar organizations subject to FBT? Yes. These expenditures shall be treated as taxable fringe benefits of the employee in full. The monetary value is the amount paid, Bangawan income taxation. What are the expenses for foreign travel which are not subject to FBT? Reasonable expenses of the employee paid by the employer for the purpose of attending business meetings and conventions are exempt. 1. Inland travel expenses, such as expenses for food, beverages, and local transportation. 2. The cost of lodging in a hotel or similar establishment amounting to an average of $300 or less per day. The cost of economy and business class airplane tickets. 4. 70% of the cost of first class airplane ticket. What are the expenses for foreign travel which are subject to FBT? The expenses for foreign travel which are subject to FBT are the following: 30% of the cost of first class airplane tickets. 2. Lodging cost in a hotel or similar establishment in excess of US $300 per day. 3. Traveling expenses paid by the employer for the travel of the family members of the employee. Note, when there is no documentary evidence showing that the employee's travel abroad was in connection with business meetings or conventions, the entire cost of ticket, including the cost of hotel accommodations and other expenses incident thereto, shouldered by the employer, shall be treated as taxable fringe benefits. Is the cost of educational assistance to the employee or his dependents subject to FBT? Educational assistance to the employee is generally taxable except when it is incurred for the convenience or furtherance of the employer's business, such as 1. Education, study of the employee is directly connected with the employer's trade or business, and 2. There is a written contract that the employee shall remain employed with the employer for a period of time mutually agreed upon by the parties. Note, educational assistance granted to dependents of the employee is generally taxable except when the assistance was provided through a competitive scheme under a scholarship program. What insurance premiums paid for by the employer are subject to FBT? Premiums on life or health insurance and other non-life insurance are subject to FBT except for 1. Cost of premiums borne by the employee for the group insurance of employees, and 2. Contributions of the employer for the benefits of the employee to the SSS, GSSIS, and similar contributions arising from provisions of the existing law. What are the non-taxable fringe benefits? Fringe benefits tax shall not be imposed on the following fringe benefits. 1. Those which are authorized and exempted from income tax under the NRRC. 2. Contributions of the employer to the benefit of the employee to retirement insurance and hospitalization benefit plans. 3. Benefits given to rank and file employees, whether granted under a collective bargaining agreement or not. 4. The minimis benefits. And 5. If required by the nature of or necessary to the trade, business, or profession of the employer. 6. If it is for the convenience or advantage of the employer. 7. Benefits received by an employee by virtue of a CBA and productivity incentive scheme, provided that the total annual monetary value received from both CBA and productivity incentive schemes combined does not exceed $10,000 per employee per taxable year. Note, exemption from FBT is not an exemption from other income taxes unless such benefit is also stated expressly to be exempt from other income taxes. What are de minimis benefits? These are facilities or privileges furnished or offered by an employer to his employees that are of relatively small value and are offered or furnished by the employer merely as a means of promoting the health, goodwill, contentment, and efficiency of his employees. What is the tax treatment for de minimis benefits? The following shall be considered as de minimis benefits not subject to income tax, as well as withholding tax on compensation income of both managerial and rank and file employees. 1. Monetized value of vacation and sick leave credits paid to government officials and employees. No limit as to the number of credits. Monetize unused vacation leave credits of private employees not exceeding 10 days during the year. Monetization of unused VL credits in excess of 10 days and monetization of sick leaves even if not exceeding 10 days are subject to tax. Note: payment of monetized unused vacation leave credits exceeding 10 days as well as payment of sick leave, regardless of number of days, shall be added to the other benefits with a 90,000 ceiling. Any amount exceeding the 90,000 ceiling shall be subject to basic and creditable withholding tax on compensation income. Medical cash allowance to dependent of employees not exceeding 1,500 per employee per semester of 250 per month or 250 per month. Rice subsidy of 2,000 or one sack of 50 kilogram rice per month amounting to not more than 2,000. Uniform and clothing allowance not exceeding 6,000 per annum. Actual yearly medical benefits not exceeding 10,000 per annum. Laundry allowance not exceeding 300 per month. Employees' achievement awards, example, for length of service or safety achievement, which must be in the form of tangible personal property other than cash, or a gift certificate with an annual monetary value of not exceeding 10,000 received by the employee under an established written plan which does not discriminate in favor of highly paid employees. Gift given during Christmas and major anniversary celebrations not exceeding 5,000 per employee per annum. Daily meal allowance for overtime work and night graveyard shift not exceeding 25% of the basic minimum wage on a per region basis. Note: the grant of meal allowance, if not for overtime work or night or graveyard shift, should be subject to income tax. However, meal allowance and lodging furnished by the employer to the employees are exempt from tax if furnished for the advantage or convenience of the employer. Meal allowance, in this particular case, should be furnished within the premises of the employer. 11. Benefits received by an employee by virtue of a CBA and productivity incentive scheme, provided that the total annual monetary value received from both CBA and productivity incentive schemes combined do not exceed 10,000 per employee per taxable year. Note: the foregoing list of de minimis benefits are exclusive, meaning all other benefits given by employers which are not included in the enumeration above shall not be considered de minimis benefits. When is de minimis benefit a part of compensation income? De minimis benefits granted by an employer shall form part of compensation income subject to the graduated rates, but only the amount in excess of the ceiling prescribed in the same given to rank and file employees. If the same were given to managerial and supervisory employees, the excess shall be subject to FBT. Note: the amount of de minimis benefits conforming to the ceiling of de minimis benefits shall not be considered in determining the 90,000 ceiling of other benefits excluded from the gross income under Section 32B, number 7, letter E of the Code as amended by the Train Law. On the other hand, the excess of the de minimis benefits over their respective ceilings prescribed under this regulation shall be considered as part of other benefits subject to tax only on the excess over the 90,000 ceiling. Define professional income. It includes the fees derived from engaging in an endeavor requiring special training as professional as a means of livelihood, which includes but is not limited to the fees of CPAs, doctors, lawyers, engineers, and the like. Who is a professional income taxpayer? It refers to a person certified by a professional body belonging to a specific profession by having completed a required course of studies and practice. It also refers to a person who engages in some art or sport for money as a means of livelihood rather than as a hobby. Distinguish professional income from compensation income. The existence of employer-employee relationship is essential in order to constitute the fees received as compensation income. This fact is material for purposes of taxation because there is no deduction allowed against compensation income except for his personal and additional exemptions, whereas allowable deductions may be made from professional income. Define business income. It arises from habitual engagement in any commercial activity involving regular sales of goods or services by an individual or a corporation. The income from business, legal or illegal, registered or unregistered, is taxable. What is the tax treatment of trade or business income? Trade or business income shall be subject to graduated rates, 5 to 32% for individuals, and normal corporate income tax for corporations, 30%. What are kinds of assets in taxation purposes? The following are the kinds of assets: ordinary assets and capital assets. What is the yardstick for determining whether a property is capital asset or ordinary asset? The yardstick for determining whether a property is capital asset or ordinary asset is its actual use. In the determination of whether a piece of property is a capital asset or ordinary asset, a careful examination and weighing of all circumstances revealed in each case must be made. What are the distinctions between ordinary asset and capital asset? Ordinary asset, property held by the taxpayer used in connection with his trade or business, includes the following: 1. Stock in trade of a taxpayer or other real property of a kind which would properly be included in the inventory of the taxpayer if on hand at the close of the taxable year. Number 2. Real property held by the taxpayer primarily for sale to customers in the ordinary course of his trade or business. 3. Real property used in trade or business, example buildings and or improvements, of a character which is subject to the allowance for depreciation provided for under Section 34, letter F of the Code. Or 4. Real property used in trade or business of the taxpayer. Note: the list is exclusive. The yardstick for determining whether property is capital or ordinary asset is its actual use. Capital asset, defined by an exclusion of all ordinary assets. All real properties held by a taxpayer, whether or not connected with his trade or business, and which are not included among the real properties considered as ordinary assets under Section 39, letter A, number 1 of the Code. Property held by the taxpayer primarily for sale to customers in the ordinary course of his trade or business, or property used in the trade or business of a character which is subject to the allowance of depreciation. When are shares of stocks be treated as ordinary assets, and when are they treated as capital assets? An equity investment is a capital, not ordinary asset of the investor, the sale or exchange of which results in either a capital gain or a capital loss. Shares of stock, like the other securities defined in Section 22, letter T of the NIRC, would be ordinary assets only to a dealer in securities or a person engaged in the purchase and sale of, or an active trader for his own account, in securities. In the hands, however, of another who holds the shares of stock by way of an investment, the shares to him would be capital assets. When the shares held by such investor become worthless, the loss is deemed to be a loss from the sale or exchange of capital asset. China Banking Corporation versus CA. What is the tax treatment of gains or losses from the sale or disposition of ordinary assets? Gains or losses from sale or other disposition of ordinary asset are subject to graduated rates in case of an individual, or normal corporate income tax in the case of a corporation. Sections 22, 32, and 34. What is the tax treatment of gains or losses from the sale or disposition of capital assets? Under the NIRC, capital losses are deductible only up to the extent of capital gains from dealings in capital assets other than domestic stocks and in real properties. Hence, capital gain and capital losses are offset. A net capital gain is an item of gross income subject to regular income tax, except for certain cases. A net capital loss is not an item of deduction against gross income. The law views net capital losses as unnecessary expenses since capital assets are not used in the business or trade of the taxpayer. Is the sale of goodwill subject to ordinary income tax? No. The sale of goodwill is not subject to ordinary income tax, since goodwill is not an ordinary asset and is not among the exceptions under the definition of capital assets in Section 39, letter A, number 1 of the 1997 NIRC. It is subject to capital gains tax. Is a membership seat in the Philippine Stock Exchange considered a capital asset? Yes. The existence of seat connotes that the taxpayer is engaged in business. A person who deals in securities or invests in stock market to monitor the day-to-day transactions will have to maintain such seat in PSC where stocks are being traded. With the said seat are some rights and privileges enjoyed by the member, which are intangible assets the taxpayer may never have carried in his books. Note, the gain realized by the subsequent sale of the seat should be included in the taxpayer's gross income. What is the relevance of determining whether an asset is capital or ordinary? The relevance of the distinction lies in the applicability of the following provisions or limitations of the NIRC. 1. Holding period under Section 39, letter B. Number 2. Loss limitation rule under Section 39. Number 3. Net capital loss carryover rule under Section 39, letter D. Note, those three provisions apply only if the seat involved is a capital asset. Section 39. What is a holding period? It is the length of time the asset has been held by a taxpayer. It covers the period from the date of acquisition to the date of sale of the particular asset. Discuss the rules on holding period. The rules on holding period are as follows. 1. In the case of an individual taxpayer, only the following percentages of the gain or loss recognized upon the sale or exchange of a capital asset shall be taken into account in computing net capital gain, net capital loss, and net income. 100% if the capital asset has been held for not more than 12 months, short-term capital gain. 50% if the capital asset has been held for more than 12 months, long-term capital gain. Number 2. In case of a corporation, regardless of the holding period, 100% if the capital gain or loss is recognized. The rule on holding period does not apply. Section 39, letter B. 3. The above rules do not apply to real property subject to 6% capital gains tax and shares of stock of a domestic corporation not traded in the stock exchange with a 15% rate. These are not included in the taxable income since these are subject to final tax already. For corporations, capital gains and losses are always 100%. English Reviewer. Note, pursuant to Section 24, letter C of NIRC, as amended by Train Law, the final tax rate for net capital gains tax on the sale, barter, exchange, or other disposition of shares of stock in a domestic corporation not traded through the stock exchange is increased from the 5/10% CGT to a flat rate of 15% CGT. In sale of shares of stock not traded through the local stock exchange, what is controlling is whether the shares of stock are traded in the local stock exchange and not where the actual sale happened. What is the loss limitation rule? Losses from sales or exchange capital assets shall be allowed only to the extent of the gains from such sales or exchanges. If a bank or trust company incorporated under the laws of the Philippines, a substantial part of whose business is the receipt of deposits, sales in a bond, debenture, note, or certificate of other evidence or indebtedness issued by any corporation, including one issued by a government or political subdivision thereof, with interest coupons or in registered form, any loss resulting from such sale shall be not subject to the foregoing limitation and shall not be included in determining the applicability of such limitation to other losses. Section 39, letter C. Will the non-use of ordinary assets intended for business convert such asset into capital asset? Generally, no. A property purchased for future use in the business, even though this purpose is later thwarted by circumstances beyond the taxpayer's control, does not lose its character as an ordinary asset, nor does the mere discontinuance of the active use of the property change its character, previously established as a business property. Exception: properties classified as ordinary assets for being used in business by a taxpayer engaged in business other than real estate business are automatically converted into capital assets upon showing of proof that the same have not been used in business for more than 2 years prior to the consummation of the taxable transactions involving the properties. May a property initially classified as a capital asset thereafter be treated as an ordinary asset? Yes. Jurisprudence has consistently held that a property initially classified as a capital asset may thereafter be treated as an ordinary asset if a combination of the factors indubitably tends to show that the activity was in furtherance of or in the course of the taxpayer's trade or business. Thus, a sale of inherited real property usually gives capital gain or loss, even though the property has to be subdivided or improved, or both, to make it saleable. However, if the inherited property is substantially improved or very actively sold, or both, it may be treated as held primarily for sale to customers in the ordinary course of the year's business. Calasanz versus Commissioner of Internal Revenue, GR 26284. Distinguish ordinary gain from capital gain. Ordinary gain as to source. Ordinary gain is derived from property used in a trade or business. As to adjustments, ordinary gains are not adjusted by the holding period. As to deductibility, ordinary losses can be offset from both ordinary gains and capital gains. Capital gain as to source. Capital gain is derived from property not used in trade or business, whether or not connected thereto. As to adjustments, some types of capital gains are adjusted by the holding period. As to deductibility, capital losses can only be offset from capital gains. I explained the concept of actual gain and presumed gain. As a general rule, the income tax law imposes tax only when there is actual income, gain, or profit by deducting the cost or adjusted basis of the property sold from the amount realized, Section 40. This is known as actual gain. However, as an exception, where an individual or a corporation sold a real property, land, or building classified as capital asset, the law presumes that there was a capital gain realized, and the capital gains tax is 6% of the actual consideration or the fair market value at the time of sale of the real property, whichever is higher. This is known as the presumed gain, but as an exemption to the exception, the rule on presumed gain does not apply to sale of shares of stock of a domestic corporation not listed and sold through a stock exchange, because there is actual gain whenever an individual or corporate taxpayer sold shares of stock treated as a capital asset. Distinguish the subject of capital gains tax on the sale of real properties by an individual and a corporate taxpayer. The following are the distinctions between individuals and corporate taxpayers as regards the subject or capital gains tax. Taxpayer: citizen, resident or non-resident. Capital gains taxable: the capital gains presumed to have been realized from the sale, exchange, or other disposition of real property located in the Philippines, classified as capital asset. Capital gains taxable: the capital gains presumed to have been realized from the sale, exchange, or other disposition of real property located in the Philippines, classified as capital asset. For resident alien, Section 24. Non-resident alien engaged in trade or business or not within the Philippines, capital gains realized from the sale, exchange, or other disposition of real property. Non-resident alien not engaged in trade or business within the Philippines, capital gains realized from the sale, exchange, or other disposition of real property. Domestic corporation: gain presumed to have been realized on the sale, exchange, or other disposition of lands and/or buildings which are not actually used in the business of a corporation and are treated as capital assets. The NIRC does not impose the 6% capital gains tax on the realized from the sale of machineries and equipment. Is the labor union required to pay CGT when it sells its property? No, but being an individual, state, or trust, a labor union is not required to pay capital gains tax when it sells its property, and gain realized from the sale is ordinary income. Section 22, letter C, subject to income tax under Section 27 of the Tax Code. Is the transfer of title to real property from the trustee to the beneficiary without monetary consideration under and by virtue of the deed of acknowledgement of implied trust and waiver of rights and interest to real estate properties subject to capital gains tax? No. There is in fact in law no transfer of beneficial ownership, since the naked ownership of the trustee and the beneficial ownership of the beneficiary are consolidated in the latter. BIR ruling number 10898, June 29, 1998. Discuss the basis of determining the gain or loss from sale or exchange of property. If the property is acquired by purchase, the basis is the cost of the property. 2. By inheritance, the basis is the fair market price or value as of the date of the acquisition. 3. By gift, the basis shall be the same as if it would be in the hands of the donor or the last preceding owner, by whom it was not acquired by gift, except that if such basis is greater than the fair market value of the property at the time of the gift, the basis shall be such fair market value for the purpose of determining loss. 4. For less than an adequate consideration in money or money's worth, the basis is the amount paid by the transferee for the property. 5. Tax-free exchange transaction. Shares of stock received by transferor, original basis less the money received and fair market value of the other property received, plus the amount treated as dividend of the shareholder and the amount of any gain that was recognized on the exchange. B. Property transferred in the hands of the transferee, same as it would be in the hands of the transfer, increased by the amount of the gain recognized to the transfer on the transfer. Distinguish net capital gain from net capital loss. Net capital gain means the excess of the gains from sales or exchanges of capital assets over the losses from such sales or exchanges. Net capital loss means the excess of the losses from sales or exchanges of capital assets over the gains from such sales or exchanges. What is the difference of the tax treatment of net capital gain from net capital loss? The net capital gain, except capital gains subject to final tax and personage tax, shall be reported in the taxpayer's income tax return and shall be subject to the graduated income tax rates in addition to the net income from other sources. The net capital loss cannot be deducted from the ordinary income because the loss can be deducted only to the extent of capital gains. What is the general rule on exchange of property? Upon the sale or exchange of property, the entire amount of the gain or loss, as the case may be, shall be recognized. Note, the following are the exceptions. 1. Gains are recognized, but losses are not recognized in transactions between related parties. 2. No gain or loss shall be recognized if in pursuance of a plan of merger or consolidation where there is an exchange solely in kind. Section 40. 3. No gain or loss shall be recognized if property is transferred to a corporation by a person in exchange of stock or unit of participation of which, as a result of such exchange, said person alone or together with others not exceeding 4 gains control of said corporation. Section 40, letter C, number 2. And number 4, gain is recognized but loss is not recognized where the exchange is not solely in kind. Who are related taxpayers? The following are related taxpayers. 1. Members of the same family, brothers and sisters, whether by full or half-blood, spouse, ancestors, and lineal descendants. 2. Stockholders and a corporation, when the stockholder holds more than 50% in value of the corporation's outstanding capital stock, except in case of distribution in liquidation. 3. Two corporations more than 50% in value of outstanding capital stock, of each of which is owned, directly or indirectly, by or for the same individual, if either one of such corporations, with respect to the taxable year of the corporation preceding the date of the sale or exchange, was a personal holding company or a foreign personal holding company. 4. Grantor and fiduciary in a trust. 5. Fiduciary of a trust and fiduciary in another trust, if the same person is the grantor with respect to each trust. And 6. Fiduciary of a trust and beneficiary of such trust. Section 36, letter B. Define exchange solely in kind. It is an exchange of property with another property, and no money is involved. Example, shares of stock exchange for shares of stock. What are the instances when the gain or loss on the sale or exchange of property is not recognized? No gain or loss shall be recognized if 1. A corporation which is a party to a merger or consolidation exchanges property solely for stock in a corporation which is a party to the merger or consolidation, property for stock. Number 2. A shareholder exchanges stock in a corporation which is a party to the merger or consolidation solely for the stock of another corporation, also a party to the merger or consolidation, stock for stock. 3. A security holder of a corporation which is a party to the merger or consolidation exchanges his securities in such corporation solely for stock or securities in another corporation, a party to the merger or consolidation, security for stock. 4. If property is transferred to a corporation by a person in exchange for stock or unit of participation in such a corporation of which, as a result of such exchange, said person, alone or together with others, not exceeding 4 persons, gains control of said corporation, provided that stocks issued for services shall not be considered as issued in return for property. State planning. Note: control means ownership of stock in a corporation possessing at least 51% of the total voting power of all classes of stock entitled to vote. Section 40, letter C, number 6. What is the net loss carryover rule? NCLCO. Under the NCLCO, if any taxpayer other than a corporation sustains in any taxable year a net capital loss, such loss in an amount not exceeding of the net income of such year shall be treated in the succeeding taxable year as a loss from the sale of exchange of a capital asset held for not more than 12 months. Example, deductible in full. Section 39, letter D. Note: this is an exception to the general rule that losses shall be deducted from the gross income in the same taxable year in which the losses were incurred. Commissioner of Internal Revenue versus Powell. Discuss the taxability of gains derived from dealings in real property situated in the Philippines. If the real property is 1. Capital asset, regardless of the holding period, a final tax of 6% shall be imposed upon capital gains presumed to have been realized from the sale, exchange, or other disposition of real property located in the Philippines, individuals, states and trusts, or land or building corporations classified as capital assets based on A. Gross selling price, B. Current fair market value as determined by the Commissioner, or C. Current fair market value as shown in the schedule of values of the provincial and city assessors, whichever is higher. Note: capital gains tax may also be due in pacto de retro sales and other forms of conditional sales. Gains from sales or other dispositions of real property by an individual to the government or any of its political subdivision or agencies, or to government-owned and controlled corporations, may be subject to, or at the option of the taxpayer, to the graduated income tax rates of 6% capital gains tax, Section 24, Paragraph D, Number 1, ordinary asset, Number 2, subject to graduated rates in case an individual or normal corporate income tax in the case of a corporation. What is the nature of capital gains tax? Capital gains is a tax on passive income. It is the seller, not the buyer, who generally would shoulder the tax. Republic of the Philippines, represented by Department of Public Works and Highways versus Arlene Soriano, GR 211666, 2015. Are real properties transferred pursuant to expropriation proceedings subject to capital gains tax? Yes, the transfer of property through expropriation proceeding is a sale or exchange within the meaning of Section 24 letter D and 56 letter A number 3 of the tax code, and profit from the transaction constitutes capital gain. Such capital gains is subject to capital gains tax. Republic of the Philippines versus Spouses Senando Salvador and Salvador, GR 205428, 2017. Note, the expropriation of property classified as capital asset is subject to CGT or capital gains tax and DST based on the amount of just compensation. It is not subject to CWT and VAT. Ruling number D 21207. Who is liable for capital gains tax in expropriation proceedings? The seller is liable. It is settled that the transfer of property through expropriation proceedings is a sale or exchange within the meaning of Sections 24D and 56A number 3 of the NIRC, and profit from the transaction constitutes capital gains. Since capital gains tax is a tax on passive income, it is the seller, or respondents in this case, who are liable to shoulder the tax. Thus, as far as the government is concerned, the capital gains tax in expropriation proceedings remains a liability of the seller, as it is a tax on the seller's gain from the sale of real property. May capital gains tax be awarded as consequential damages in expropriation proceedings? No. If only part of the property of the owner was expropriated, the amount of capital gains tax cannot be awarded to the owners as consequential damages. Consequential damages are only awarded if, as a result of the expropriation, the remaining property of the owner suffers from an impairment or decrease in value. Given that the payment of capital gains tax on the transfer of the subject property has no effect on the increase or decrease in value of the remaining property, it can hardly be considered as consequential damages that may be awarded to owners. Republic of the Philippines versus Spouses Salvador. Are all capital gains realized in case of sale of real property subject to 6% capital gains tax? No. Capital gains presumed to have been realized from the sale or disposition of principal residence by natural persons may be exempted from the 6% capital gains tax subject to conditions prescribed by law. Section 24, letter D, number 2. To be exempted, the following requirements must be met. 1. Sale or disposition of the old actual principal residence. 2. By a citizen or residential alien. 3. Proceeds of which is utilized in acquiring or constructing a new principal residence within 18 calendar months from date of sale or disposition. 4. Notify the Commissioner within 30 days from the date of sale or disposition to a prescribed return of his intention to avail the tax exemption. 5. Can be availed of only once every 10 years. 6. The historical cost or adjusted basis of his old principal residence shall be carried over to the cost basis of his new principal residence. 7. If there is no full utilization, the portion of the gains presumed to have been realized shall be subject to capital gains tax. The GSP or FMV at the time of sale, whichever is higher, shall be multiplied by a fraction which the unutilized amount bears to the gross selling price in order to determine the taxable portion. And 8, subject to release upon certification by the RDO that the proceeds of the sale have been utilized. Escrow account. Section 24, letter D. Discuss the taxability of dealing in shares of stock not listed and traded in the stock exchange. Regardless of the holding period, a final tax at the rate of 15% is imposed upon the net capital gains realized during the taxable year from the sale, barter, exchange, or other disposition of shares of stock in a domestic corporation except shares sold or disposed or through the stock exchange. NIRC as amended by Train Law, Section 27, letter D, number 2. How is selling price determined? The following rules shall apply in determining the selling price. 1. In the case of cash sale, the selling price shall be the total consideration per deed of sale. Number 2. If the total consideration is partly in money and in kind, the selling price shall be the sum of money and the fair market value of the property received. Number 3. In the case of exchange, the selling price shall be the fair market value of the property received. And number 4, in case the fair market value of the shares of stock sold, bartered, or exchanged is greater than the amount of money and or fair market value of the property received, the excess of the fair market value of the shares of stock sold, bartered, or exchanged over the amount of money and the fair market value of the property, if any, received as consideration shall be deemed a gift subject to the donor's tax under NIRC. RR number 0608, Section 7, letter C.